The exponential moving average, EMA, is a widely used technical indicator in financial analysis, particularly in trading and investment strategies. Unlike the simple moving average, SMA, which gives equal weight to all data points within the selected period, the EMA gives more weight to the most recent data points. This makes the EMA more responsive to price changes and better suited for identifying trends in volatile markets. The primary formula for calculating the EMA involves a smoothing factor, also known as the weight multiplier, which determines the degree of emphasis on the most recent prices. The exponential nature of the EMA means that recent prices are weighted more heavily, allowing the indicator to react more quickly to new information, such as sudden price moves or market sentiment changes. EMA is often compared to other trend-following indicators, such as the simple moving average, SMA, and the weighted moving average, WMA. While the SMA provides a more general view of price trends by averaging prices over a set period, the EMA gives more weight to recent prices, making it more sensitive to the most current market conditions. Traders commonly use the EMA in conjunction with other indicators, such as the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD, to generate buy and sell signals. One of the most popular uses of the EMA is the calculation of the crossovers, where a short-term EMA crosses above or below a longer-term EMA, signaling potential bullish or bearish trends. The EMA's increased sensitivity to price movements also makes it a valuable tool for traders who want to capture short-term trends or respond to price fluctuations. For example, traders may use the 9-day and 21-day EMAs to detect momentum shifts, or the 50-day and 200-day EMAs for long-term trend analysis. While the EMA offers advantages in its responsiveness, it can also be prone to generating false signals in highly volatile or sideways markets. This is why it's critical to pair the EMA with other tools and strategies to confirm trends and manage risk effectively. In conclusion, the exponential moving average is an essential tool in technical analysis, offering a more dynamic approach to tracking price trends compared to other moving averages. Its responsiveness to recent price action makes it suitable for both short-term traders and long-term investors, though its sensitivity can also result in occasional false signals. Therefore, it is crucial for users to understand its characteristics and use it in combination with other indicators to enhance decision-making and improve trading strategies.